Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Portillos Incorporated, ticker PTLO. This was a requested stock, so we're going to dive in, see what the fair value and potential growth is for it. So I'm coming up with a fair value around 15 and a half. Discounted cash flows of 10.29. Cash flows here are not very strong. Not too surprising for the industry. It's a restaurant company. And the actuals. Ooh. The actuals that we're looking at, it's currently just shy of $13. It reached a low of 12.57, so it's kind of closer to its low, and a high of 24. It IPO'd back in 2021 at $26, so it's below the IPO price. In fact, for a little bit, it was trading in the 40s. I think it reached an all-time high of 57.72 from what I was looking at. Those people definitely are not happy. Earnings yield 1.67, pretty low. They need to come in with a 0.65 EPS for a reasonable earnings yield, and we're not seeing that anywhere in the near future. At least analysts aren't projecting that. 0.32 in 2023, 0.43 2024, and 0.54 2025. So on an earnings basis, it's trading at valuations 3 years out at least. Cash flow yield came in negative this last year. Looks like they did a lot of spending, so that's not a huge red flag. Usually they're coming in with cash flow yield around 2%. We'd look to make sure that it goes positive again, and north of 2% would definitely be nice. ROE, not too bad. 5.72, but that debt to equity is 2.87, so it is high, definitely higher than we'd like. ROI, they basically have broken even on their investments, and ROA, their assets are not giving them much of a return. Not a huge surprise there when you see their net margins. This definitely is not the type of business that I would invest in. Gross margins aren't too bad, right around where we like to see them, but that net we'd really want to see around 10%, not 3%. And in a restaurant business like this, that 3 is pretty typical. Over the last 4 years, they have been essentially breaking even, so they did have a pretty good year. Revenue-wise, growth looks good, nearly double digits across the board, so we're going to put in, looks like analysts basically agree just shy of 12% growth over the next 2 years, and we're going to use the same for the thesis. Share counts, they issue a lot of shares, and that definitely hurts investors. Like to see them slow that down. Ideally, would like to see them buy back shares, but they need to take care of some of that debt first. So that's definitely the biggest red flag there. Double-digit share count growth, definitely not something that I would be touching. They're diluting your position incredibly. You have nice double-digit revenue growth, asset growth, margin growth if they can keep on the trend that they're on, but it's all washed away by that share count growth that's getting you 3% returns annually, which is nothing. You're underperforming the market significantly, and that's why over the 5-year time period, you're not making anything. 3% is not worth touching. Assets, they're pretty big on asset growth, double digits across the board. Would like to see them step it up more towards that 15% 11.5 is what they've come in on average for the last 2 years. 13 might be a little high, but I did want to make sure that it was outpacing the liabilities, where they have been ramping up the growth in those liabilities. 6.34 for the 3 year, 17.11 for the 2 year. So hopefully that doesn't continue to ramp up. The midpoint between those two would be somewhere around 11, 11 and a half. So that's what we're going to use for the thesis here. And then margins, I'd like to see them get up to 5%. That'd be 13% annual growth. From what we see, that might not be too unreasonable. They have really good gross margins. If they can cut back some expenses, then they might be able to get there. So if you were to purchase at today's prices, you'd be looking at almost $2 growth in the next 3 years in the fair value, and 2.5 in the next 5 years, because that 3.2% is nothing. That's underperforming inflation at the moment, but on a good year, factoring in inflation, you're getting 1%. You might as well. You'd be just as good just holding that cash in a savings account. So what can they change that would make this significantly better? The biggest lever that we're going to have is the share count. Like if we take this down to 5% instead of 15%, well, there you go. I'd buy this stock in a heartbeat. 13% growth, but that's not what we're seeing. We're seeing them growing their debt and issuing shares to pay that down when it's already very high. I mean, we can take a look at the balance sheets here. Assets having some nice growth. Don't like that they have a negative tangible assets, but it is trending in the right direction. Liabilities had a great dip in 2021 and are going up very quickly since then. And their tangible book value is negative as well. I'd like to see that trend in the positive direction. So the story here really comes down to if they're done issuing debt and if they're going to be able to take these liabilities down to a point where they can start buying back shares and stop issuing them. Cash flows are nothing impressive here. Not really surprising for a restaurant. And then all of the valuations graphed out. You see cash flows are kind of on a downtrend. Earnings have stabilized. 2022 forward, nice linear growth. The fair value right here in the middle, bouncing around a little bit, but on a decent trend. And then the actual share price, you can see the crash in here. It's not been a pretty stock for investors, most likely due to all of those new shares being issued. And then the balance sheet, as long as their assets outpace their liabilities and growth, could be good going forward. I mean, that's where they have a lot of value. They do have quite a bit in assets. So we might be able to place this one on the watch list. I mean, even if they bring down their issuance of new shares to 10%, you're looking at almost market returns, but you are beating out the market in the next 3 and 5 years. So there is a decent story here, so long as they can get the share count under control. Like even if they issue shares, as long as it's less than the revenue and asset and margin growth, then you will see some growth as an investor. But if it's outpacing those as it has been, your position's just going to be eaten away. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.